Okay, 754. What's this first? Let's see. Sam, what's this first slide say?
When should we analyze a transaction to determine whether 754 applies? Elements of a transaction. A. Transfer of units by a partner. B. The transfer of units are a sale or exchange of units or death of a partner. There are two general instances that should be recognized to trigger the analysis.
Where are they, I wonder? Okay. You might want to, just for purposes of we're on a learning curve, highlight the word partner. Because 754 does not apply to an S corp. 754 doesn't apply to a C corp. 754 applies only to a partnership. And, the only reason I'm saying that out loud is because we're talking about this concept, and if I don't anchor it to partnership, the fear I have is you could actually think this applies in other places. Okay.
Is the death of the partner, is that because of the step up in basis? Or, to fair market value?
Say that again?
Is the reason for death of a partner, is that because of the step up in basis?
Yes.
Okay.
Or step down.
Yeah.
One of the two.
Yeah.
Okay, so there's two categories that that occur. There's two categories of transactions that a 754 that possibly could result. One is a partner-to-partner transaction, and one is a partner-to-partnership transaction. Okay, so this slide is showing that assume A, B, and C own a third, and a third of L1. L1 is a partnership. We have two different scenarios, and these two different scenarios are meant to demonstrate there's two possibilities to have a partner-to-partner transaction. Okay, so the left side of the screen is A buys B's units, and once that happens, you'll see that it goes from a third, and a third to 66% A and 34% B because A had his or her interest concentrated by virtue of buying out B's interest. The second is, C sells to a third party, not an existing party, and A, B, and D own L1, a third, and a third. So you have a partner-to-partner transaction where the existing partners might buy somebody out, or a partner-to-partner transaction where I have a third party coming in. The selling to a third party probably is slightly more prominent. Then you have partner-to-partnership, where the same fact pattern, you have A, B, and C owning L1, and A and B want to continue in L1, and C wants his cash, his or her cash. So L1 goes to its bank account and grabs some money out of its bank account, or a promise to pay, and pays C, I'm going to say $1 million just for illustration purposes, and C surrenders his interest, whereby it was a third, and a third, and now it's 50-50. Okay, so 754 is going to result from a partner-to-partner transaction or partner-to-partnership transaction. Okay, so let's go back one page, just for the hell of it, because this is what I do. 754, and I might have even had this page before that. Okay, who read this slide? Was it you, Sam? What's the first line say? The very first line.
When should we analyze a transaction to determine whether 754 applies?
Well, read the whole thing.
754 or 734, 743.
Okay? So 754 basically states that you have the opportunity to step up or step down the assets of the partnership when you have a partner-to-partner transaction or you have a partner-to-partnership transaction. Okay? That's what 754 says. 743 says the rules How you interact with a partner-to-partner transaction is set forth in 743. So when you see on a K1 a 743 adjustment, you know that that was a partner-to-partner transaction. And then on 734, it would be partner-to-partnership. So if you go to the next page, this would be partner-to-partner. So this would be 743. And then the page after that would be 734, partnership to partner. Okay, let's think about it. Does 754 apply to any of the following transaction? Partnership A, B, and C redeems. Who can define redeems? I mean, that's kind of a term of art on some level, as I've come to discover. What does it mean, redeem? Matt?
I would say that the partnership has their shares and the partner holds those shares.
Okay.
To receive like income from the partnership, and the partnership has the option to buy back those shares at any time.
Okay, so you're sniffing around it for sure. So redeem or redemption is it's a term of art both in partnerships and corporations. So redeem or redemption means that the stakeholder, the partner or the shareholder, sells back their equity interest back to the entity that issued it. So a redemption of a partnership interest means, if we go back to L1 in the previous pages, L1 redeemed the 734 transaction, where we say it's partner to partnership. The partnership is redeeming out or buying back its own equity interest from its equity member. So L1 purchased L1 units back from C in the previous slide. That's L1 redeeming C's units, or said in an alternative, L1 had a redemption of C's units. So the word redeem or redemption is something that it goes well beyond tax. But in tax, when somebody says there's a redemption, the issuing entity is buying back its own equity interest. That's what a redemption, or when somebody's redeemed out, that's what that means. So, Matt, if that's true, what does one mean? Does 754 apply when we say?
Yes, I believe it applies.
Okay, it does. Okay, who you want to call in?
Let's go with Connor McCraddock.
Okay, what do you got?
Number 2, just read it out.
2.
Partner A sells her partnership interest to a third party at a $300K gain. Wouldn't that be the 731, not the 754?
Okay, so 754, that's a great distinction, because I mean, again, we're fumbling about and we're trying to figure out what all this means. 754 is the code section that says, Connor, you have the option or the ability to step up or step down the basis of the assets if the partner has or if a partnership interest is transacted on. So 754 is more of a broad description of what's going to happen. But 734, which I think that's what you had, right, Matt? 734 is where the partnership redeems out or has a redemption of its units. 743, which I say is partner to partnership, correct? Where this would be a partner to partner transaction where A sold their interest to a third party or a different party. That's 743. So 754 is, do I want to step it up or down? Yes. That's you're giving an acknowledgement that you want to step it up. But then you have, if you say yes to that, if I have a partner to partnership transaction, at that point 743 is going to dictate how the step up is calculated. And we're going to talk about that. 743 is partner to partner. I sell my interest to Kaylee. Kaylee buys my interest.
Sir.
Or whatever. Shut up. Leave me alone.
Sir,
You two, to this day, I almost had it down. That wasn't even on purpose. Now,
Oh, I know that wasn't on purpose.
but if it was, yeah, I got to the point with Trent and Brett, they're now curious as to whether I'm doing it on purpose or not.
They don't even look alike.
I don't know.
Okay, it's fine. It's fine.
Okay, so if I sell my interest to Mackenzie, then that's partner to partner, and that's going to be 743 that dictates. Okay? Transfer of partnership interest. Fuck this. We're not going to do this. Transfer of partnership interest. Not going to do this. Not going to do this. Okay, so 7 because, well, okay, so let me tell you why I'm not going to do this. Okay, at least again, we're here to build the foundation, right?
He's the
I'm the foundation guy.
Oh, you're the hose guy.
Hose guy. Build a
Hotel the
guy.
hose guy.
hotel guy, hose guy,
Yeah, whatever.
foundation.
Okay, so
Diagnose.
if there's in corporate formation, so A, transfer an interest into S1, newly formed corporation, A, transfer an interest into an existing corporation, you would have to go through LLST2 in order to, Sam,
Diagnose.
diagnose what I'm shooting for here. And so let me tell you what I'm shooting for. When you put something into a corporation in exchange for corporation stock, you're under the corporate formation rules. And under the corporate formation rules, you have to, Sam,
Diagnose.
diagnose whether that transfer of that asset is a taxable transaction or whether it's a tax-deferred transaction. So the punchline, if you want to write it down, not that you're going to understand it, nor do I expect you to understand it, transfer of the partnership interest to a newly formed corporation is a tax-deferred transaction. Transfer to an existing corporation is, Max, what's my third favorite answer?
depends.
It depends. That answer is it depends because it could be taxable or it could be tax deferred. And actually the first one depends too, but it's very narrow. So that's why I'm like, why am I going to spend time, doing that? So, but if the punchline here would be is if it's transferred to a newly formed corporation, it's tax deferred. There was a transfer of the interest, but there was no tax event associated with that. Taxable event associated with that. Therefore, 754 would not apply. But the transfer to an existing corporation, if you run through the rules and it resulted as taxable versus being tax deferred, if it's taxable, then the 754 would apply. And I don't want you to know about those rules. We might as well just tell you what these are just so you can write down. S1 owns 33% of ABC Partnership, S1 liquidates, and the transfer of the ownership to ABC shareholders. Okay, so what you would need to write down here just as a placeholder is the liquidation of a corporation 99.9% of the time is going to result in a taxable event to the assets being distributed. So if that's true, then the liquidation of the corporation is going to result in a possible 754 for that partnership interest. S distributes out an interest in an ABC partnership in a partial distribution. The same answer. It's taxable. Therefore, 754 applies. 7, we've already talked about A dies. Matt, if A dies, what happens?
If A dies and D inherits A's asset, A's interest, it's 754, 743.
It is, but going back to the estate, it goes to the estate and it gets a step up in the estate, right?
Correct.
And it consumes part of our exemption, correct?
Yes.
But it is part of, see, this is how all this stuff gets interweaved in together. We learned about the estate and gift portion of it a couple days ago or whenever that was, and we went through the fact that you have 12,920,000 or whatever the number is, which that was not an inflation adjusted number. When this goes through, it gets stepped up. The heirs get, what's the holding period with respect to this interest?
They'll have the same holding period as A.
He'll have the same holding period as A. So all these things weave together. The fact that who can see this coming, right? From the standpoint, Who knew we were going to be talking about estates in 754 2 days ago? Nobody, but they go together. And the more we recognize the correlation, how all these things interrelate, the better off we are. Because what do we know today, Max? Not much.
Not much.
Do we want to be a consultant?
Sure.
Sure. In order to be a consultant, you have to know something. Okay? So, A transfers his interest as a gift. So, going back to what we learned the other day, does a gift have carryover basis or does it have a stepped up basis?
Carryover.
Has a carryover basis. So that would be a tax deferred event on the transfer of that interest. Therefore, no 754 would apply. Transfer of interest to the bank back in satisfaction. Allie, I have to come to you. What's this say? If you want to phone a friend, because man, we should know this one. What's the definition we've been hammering on?
Proceed.
Proceeds.
So it's
Is
not,
there anything in the middle of this that could sniff at proceeds?
sorry, what?
What's 9 say?
A transfer or A transfers his interest to the bank in satisfaction of a $1 million debt owed to the bank. Is it his debt or the business's debt?
It's A's debt.
A's
Proceeds are,
cash, property, and debt relief.
is A being relieved of debt?
Yes.
Yes. So I'm transferring that interest, but I'm being relieved of debt. So what happened is, in that case where I'm transferring it for the debt relief, it's as if somebody gave me $1 million or whatever number I have up there, $1 million, and then I went and paid the bank. So in that case, there would be a taxable transfer associated with that partnership interest. Let's see. I don't care. Distribution of property. Actually, I think this is what me and you were talking about, Carter, maybe. Well, I'm pretty sure it is. I'm not going to do that either. Okay, so I'm not going to worry about the book just yet. So now we're going to talk about how this really works. Because that first piece is, your takeaway from that is 754 allows us, is an election to say we are open to the assets of the partnership to be stepped up or down if an equity interest is sold or exchanged. Can we agree on that? But then you have to determine whether it's partner to partner, which that is what, Matt?
That's 743.
That's 743. Partner to partnership, CB?
734.
734. So now let's talk about what that really means. Okay? I'm going to say that you have L1, A, B, C. It's a third, and a third. Okay? Now let me give you another set of facts. This is GAAP. This is fair market value. Okay, so we have 300 of cash, both from fair market value and GAAP. We have $100,000 of AR, GAAP, and fair market value. And let's see, this is $600,000 of fair value. Well, hold on. Nope, excuse me. Where do I always start? Do you guys remember? I just screwed it up. In equity. 110, correct? And that's $1,010,000, correct? So really, that's 400, that's 610, correct? And then 1,010,000. Okay. So I'm going to start with, everybody agrees that their interest is worth $300,000. Okay? So since everybody agrees that their interest is worth $300,000, you start in the equity section, that's 900. My liability is 110, total of 1,010,000. Populate my asset side 1,010,000. Fair market value of cash is cash, AR is AR, and land is 610. It's the plug for now, and we'll just leave it there. So if we have a partner-to-partner transaction and the partnership says, you know, we're going to take out A, or we'll say C, where we ship out 300,000 of cash and C gives units back, does that look like a 734 or partner-to-partnership transaction? Okay. And for me, this is way easier. 734 is way easier than 743. Even though they both have the same underpinnings and they both have the same thought process, as accountants who deal in debits and credits, 734 is way easier. Okay? So, if we think about this in terms of debits and credits, I'm going to rewrite this over here for a second. Cash, AR, land, and I got debt, equity, A, B, C, 100, 100, 100. Now I have debt 110, correct? I have land of 10. And I have AR of 100,000. And I have cash of 30, right? And that leaves me with, I'm not even going to worry about that. I'm not even going to worry about totals. So we're saying, or 300,000. We're saying, and I'm going to call this an adjusting journal entry. And the adjusting journal entry we're going to use to draw in the concept of what's actually happening in a 754, or a 734. Because at the end of the day, the thing about a 734 versus 743, how much is C's units worth? 300,000. We agreed to that, right? Who is funding the buyout of C? Redemption was defined as what, Chris?
The partnership buys back their units.
And that's what's happening, is it not?
Yep.
And the buyer is who, Chris?
Buyers the
The
partnership.
buyer's partnership. So the buyer generally has to fund the purchase, doesn't it?
Yeah.
Okay. So would you agree that the partnership has to use $300,000 to buy out C's interest?
Yes.
You do, right? So from an entry perspective, we have 300,000 that's going to be utilized to buy them out. So that's a credit to cash. Okay? Is C going to be a partner in the partnership anymore? So is C's equity in the partnership going to exist anymore?
No.
It is not. So that's going to be a debit to C's interest, is it not? Huh. So let's see. If we think about in terms of debits and credits, we have equity of 100, correct? Is that right? So what we got so far? Then we have cash of 300, correct?
Correct.
Are we good? Or aren't we good?
Off 200,000.
We're off 200,000. Where's that $200,000 go?
Asset.
What asset? What, Matt?
Don't you like split it over like the series of assets you have?
Yeah.
To the partner that was bought out by the partnership?
100%. But we have a gap financial and we have a fair market value balance sheet, don't we?
Correct.
So if we compare the gap balance sheet to the gap balance sheet, the gap balance sheet to the fair market value cash is how much?
300,
Basis is
300.
300. What's my gain if I sold my cash? 0. What's my AR?
100 and 100.
And the gain?
0.
0. If I sold my ground,
600.
600. Okay? So this column, this fair market value column, McKinsey would tell you, because she's dealing with the client, or it lets M&A, how to populate the fair market value column. She would give you that information. You guys would not have the wherewithal. I don't have the wherewithal. McKinsey doesn't have the wherewithal. You don't have the wherewithal to say what that fair market value column should be populated with. You can say the population of assets I'm dealing with is cash, AR, land, debt, and equity, but you're guessing at the fair market value column. And the fair market value column is wildly important in order to go, okay, I got to compare my fair market value column to my gap column to figure out where the gain is residing, to know where the step up or step down should be. So this is a slight variation or version. Remember I said the equation that we're dealing with was assets equals liabilities plus equity? And I also said proceeds, the definition of proceeds is cash, property, and debt relief. All that is encapsulated in this. All those things are intermingling and intertwined in this analysis, because basically all we're doing is a gain-loss calc. That's all we're doing with respect to this. Okay? So now with respect to that, you said Max, we had a dangling debit, correct?
Correct.
And based on this analysis of fair market value versus gap, what do you think my debit should be? Land. $200. So a 743, and I'm going to take this a bit further and to refine this, but in my mind, 754 is basically saying what? You have the opportunity to step up to the basis of the assets of the company. 734 says, well, when you have a partner to partnership transaction, if you have the wherewithal to think in debits and credits, 734 is way easier to wrap your mind around overall. So now, if I come, does anybody want to take a picture of this before I erase anything? All right. Okay. Okay, so at this point, if you do your debits and credits, your cash is gone, correct? Your C equity is gone. Your land is now 210 grand. And this is, it puts down now to 310. This now puts down to 310. So now when the partnership goes and sells the property, the basis that started out at 10,000 is now 210,000. And let's, just in order to compare and contrast with 743, which is, Sam, 743 is partner to partner?
Partner to partner.
Yep. Partner to partnership, L1, because it's a redemption, utilized its balance sheet in order to affect the transaction. And since L1 used its balance sheet to effect its transaction, it moved L1's balance sheet. There was a change. We transformed $300,000 of cash into $200,000 more of additional basis to the ground and the elimination of the equity of C. You move the balance sheet. Okay? So a 754 statement or a 754 election, I mean, this is just thought process. But when you go through this, there's going to be a 754 election on the return, and I wish I brought an example of it, that's going to say, is this 734 or 743? What are the proceeds? Proceeds in this case, Carter, was how much?
I don't know.
300.
You're zoned out.
It's going to be, in this case, it would be genuinely, it would be cash plus debt. You'd have to take their proportionate share of the debt to make this all work. But I'm going to push that aside because anybody that wants to talk about those statements, because I'm going to overwhelm you if I'm not careful. Because we're here to be what?
Build foundations, not experts.
Not experts. Okay? So, I'm going to take this one step further because the possibility, and we're going to keep the facts. We're going to keep the facts exactly the same. 300 of cash, 100 C still in the game, and it's Gap Financial. Okay? Mackenzie, if we have a Gap Financial, should we assume automatically it's tax basis?
No.
No. Okay, so now, in order to make sure that we have the right 754 deduction, Max asked me if this is on Gap equals tax. Is this Gap equal?
Oh, does gap equal tax?
No, I'm cash basis. Okay? So if I'm cash basis, and I'm going to say that this is bank debt and not AP. Let me ask this question. On cash basis, is my cash on cash and gap basis the same?
Yes.
It is. Is AR the same?
Yes.
So for tax basis and gap basis, it's the same. If I'm cash basis taxpayer. Jackson's
On the return.
yeah, Jackson's shaking his head no.
On the return, no.
How much basis do I have in my AR, Jackson?
Basis, is it 100? Or
How
I
much?
guess I don't know if that's-
How much of the 100,000 have I actually paid tax on?
none of it yet.
None of it yet. So, if the person that owed me the money paid me $100,000, would I have a taxable event?
Yes.
Okay, so let's go back to the simple definition of proceeds. We're going to pretend we're selling it. If somebody gave me $100,000 of cash and I sold it, I'd have 100 of proceeds, but my basis would be 0. So if this is GAAP, and this is a process that we need to go through when you have the 754, is you have to convert to tax basis. So I would reduce that down to 0, would I not? So that's a credit to AR. Where do you suppose the debit goes?
Cash. Or, oh, no, sorry. We want to decrease our income.
Your equity,
Yeah.
333. Okay, so this goes to 0, does it not, Jackson?
Yes.
300, 210, or nope, excuse me, that's 10,000. Okay, and this is 110. And I got 67, 666, right? Is that right? Why is that one? That's 310. Why am I off? It's 410. That's 410. Why am I off? What am I missing?
Because you're reducing the equity by 33.
Do what?
It's 66. It's all sixes instead of the 7.
But, are you sure? Yeah.
Yeah, I think so.
So 310, but if this is 100, that's 210, right?
It's 200 at the bottom.
Do what?
Right. It's 200 at the bottom.
120,
Oh, shit, okay.
130.
I'm like,
Two.
what the fuck is wrong with me? I was having a moment. Okay, so this is 310 or 210, correct? 310? All right, 310. Yeah, 310. So my fair market value, same as before, is 300K, 100K, and we said that this was how much? 610?
Yeah.
And 110, and then 300 all the way down. And then you would do the same journal entry with the same fluxing that you did before. So the first point I want to make on a 734, in order to capture the idea of what you're doing with the 734, is you got to think in debits and credits. The entity is using its own assets, credit cash, debit equity, and then everything falls out in the middle based on fair value. The second concept is you start with a GAAP financial. GAAP doesn't necessarily mean that it's on tax basis and that you have to get it on tax basis in order to do the calculation. So based on this brief little small fact pattern, I've got a GAAP financial. We are on cash basis. We have to back out the AR, which then you have a hit to equity to get to the same tax basis balance sheet, or a revised tax basis balance sheet, and you have fair market value to compare. So if we do that, we have 0 gain, 100 of gain, we have 600 of gain for 700, correct? So if we redeem somebody out of the company for $300,000, that's going to infer a 30 step up of 33K and 200K. And the elimination of the 6 of equity, right? That's the same thing as what we did before.
How do you step up AR? I mean, isn't that just like that's what you're supposed to receive from customers, correct? So how come, I don't know.
How come you get to step it
So
up?
you're gonna take I don't know, you're changing your balance that you expect to receive when that, in reality, that balance isn't
Did I
changing.
really change the balance? I'm still expecting to receive 100. So let me ask you a question. If you're a cash basis taxpayer and you have $100,000 of AR and $100,000 of equity, but your balance sheet's really 0, okay? If Jackson is your client and he owes you $100,000, you collected, how much income do you have?
If you collect it, you have 100,000.
You collect, you had $100,000. Well, I'm a believer in your business, so I'm going to buy your business. So I pay you for the assets of the business. I pay you $100,000 for your AR. How much income do you have on that AR?
I have 100,000 on it.
100, because you got 0 basis in it, the same way you do with Jackson, as if he's going to pay you. Okay? So going back to what we said earlier on the hurdles, We had multiple things that adjusted basis, and one of them was acquisition cost. So did I buy your AR?
Yes.
Yes. So do I have an acquisition cost associated with that AR?
Yes.
So my basis in that AR is how much?
33,000.
No,
I guess. Oh, it'd be 100,000.
it'd be 100,000. So now I knock on Jackson's door and I say, Jackson, I want my money. And he said, yep, no problem. And he pays me the 100,000. So by virtue of me buying your AR, between the two of us,
Right.
I get a step up to the value.
It's just the basis on that. It's not the actual.
Correct. Correct. So in this case, you have partner A, B, and C, correct?
Yep.
Okay? And they're a third, and a third. Correct?
Mhm.
And a third interest is worth $300,000. Correct?
Mhm.
The partnership uses $300,000 to buy out C. Okay? So let's go back over here. We have a tax basis balance sheet, 300, 0 in AR because we're cash basis, 100 or 10,000 in land, 110, and whatever that mess is down there I screwed up. Okay? We have 300 of value, 110 of debt, which results in 300 of value in my cash, 100 of value in my AR, 610 of value in my land. And we redeemed out C, correct? So when we redeemed out C, a third partner, 1/3 partner was taken out of the enterprise, correct? So your step up, your rule of thumb, your check figure is the inherent gain of 100 times 1/3 should equal my step up. Because I bought 1/3 of that by virtue of taking out C. And 1/3 of my inherent gain associated with the ground should be the 200,000 if I took out a 1/3 partner. Okay, so now when the partnership collects that $100,000 AR,
You only pay tax on.
they won't pay tax on
Correct.
the 33
Got it.
because we effectively bought that from you, is what happened.
Right. That makes sense.
There's a lot of moving pieces here. Okay, so the 743 again is way easier to understand. And I'm going to go back and we're going to do it again. Because I'm not going to worry about the convert to tax basis. Let's see. Matt, why are we here to be experts?
No,
What are we here to do?
build a foundation.
To build a foundation. So all we're doing is building a foundation. So in the pursuit of building that foundation, let's do that again and think about how does this work? Okay, so we have this fair market value balance sheet of 300 apiece, correct? And we have 300 or 110 in PP&E, and we said that the client told us that the AR was what it was. We're not worried about tax basis versus not. Okay? So let's just, again, go back to the very, very simple. What's the entry to take out C? C's equity is worth how much? 300,000. So how much cash do we have to use to buy out C?
300,000.
300,000. So that would be a debit to cash or credit to cash, correct? Debit, credit. Cash was how much?
300,000.
Okay, and we know C is no longer going to exist in the entity. So we have to eliminate C's equity from this deal. So equity, is that a debit or credit?
Debit.
Debit of 100,000. And based on going through the process, again, you have to go through the process of saying, what's my GAAP basis / tax basis? Because again, we went back and said, wait a minute, GAAP and tax are not always the same thing. if you have a GAAP basis financial, you have to pursue converting that GAAP financial into a tax basis. In this case, they're accrual-based taxpayer. So GAAP and tax are going to be equal in this case. So you have to start with GAAP, get the inherent gain from the client, because I don't know it, McKinsey don't know it, you don't know it. The client has to tell us where that inherent gain resides. So once we start with the knowns in our entry associated with the 743, the knowns that we have on the balance sheet are cash and equity. Because here's cash, here's equity. And for lack of a better description, which I've never thought about this before, this is the knowns, I'm going to call it knowns, never thought about this before, are coming from my tax basis column. It's coming from here, and it's coming from here. So those are knowns from tax basis. So the dangling debit that or dangling credit has to be coming from my fair market value column. So my inherent gain column. My inherent gain, which I don't have here, but my inherent gain is 600. So my inherent gain is embedded where? My inherent gain says, is my inherent gain embedded in my cash? No. Is my inherent gain embedded in my AR? No. Is my inherent gain embedded in my land?
Yes.
So my dangling debit is land. Okay, and this is a very, very high level introduction to 754 because McKinsey, how many 754s do we have?
How many?
Is this more than zero?
Yeah,
It's more than zero. Do you think somebody in this room is going to be affected by a 754?
for sure.
For sure. I like her confidence. Okay, so 734 again, to me is a wildly more easy concept to think about and where the step up goes. So let's write the procedure down just for the hell of it. Step one, what is my GAAP balance sheet? Step two, convert GAAP balance sheet to tax basis. Convert GAAP balance sheet to tax basis. Step three, inquire to the client or manager or partner, what is the fair value of the assets that are populated on the balance sheet? Where do we always start on the balance sheet when we're doing the fair value? The equity section is where we start. And then we add the liabilities, right? And then when we have the equity plus liabilities, we know the sum total of 1/2 the balance sheet. Then when we know the sum total of 1/2 the balance sheet, we know the total on the asset side of the balance sheet. Then we know what all the assets have to foot to. We always start with the equity section. So once we have that, and we have the fair market value of all the assets, then you're going to pretend to put on your Sailor Exchange hat, even though we're not having a Sailor Exchange hat, and compare the same way we did over here. Well, if my fair market value is 300 and my basis is 300 and I have a gain loss or sale of that asset, I have a zero gain associated with that asset. If I have $100,000 of basis in my AR, $100,000 of basis in my or fair value in my AR, there's no gain or loss on that asset. If I have $10,000 of basis in my land and $610 of value in my land, then my inherent gain in that land is $610. You could possibly, like we had before, when we converted the balance sheet to tax basis, because we were cash basis AR, we had two inherent gains, correct? We had an inherent gain in AR and we had an inherent gain in land. This particular case, we only have inherent gain in land, okay? So once you now have that inherent gain in the land, you now do your debits and credits and shove the dangling debit or credit, depending on how this works, because you could have a step down asset, dangling debit to those assets that are in your inherent gain column. So your debits and credits are going to include items from your tax basis balance sheet, and it's going to include items from your inherent gain balance sheet where things pop out with an inherent gain. Everybody has their procedure written down?
Is that 1.9 million?
Is it
Yeah, with the 80.
80? 100?
Yeah, that's lowering it, but
Do what?
am I losing it? I think it's 1.9 million.
Yeah, I think you're right.
Okay, so
Just increased building by 4.
I like the way you roll. If your number's right, thank you for checking. Yeah.
It is definitely 200. Was that right? Yeah, I think it was.
Was it right?
Yeah.
300. No, 500. No, it's right. A million, 1.2 million, 1.6
That's
million.
6, 5, yeah.
And then you add 500 back. Why are you guys gaslighting me right now?
add.
2 of them.
Are they screwing with you?
Dude.
This hotel guy screw with you?
Yes.
100%.
Show
That
out
wouldn't-
Travaglia.
Making sure he's awake.
Okay. So what's the first question you have to ask?
Are you on tax basis?
Does GAAP equal tax?
Yes.
No, we're on cash basis.
Okay.
And you know what? I don't like your change. That makes everything easier. Okay? So do we have to convert it to tax basis? And how do we do that? Think about it in AJE.
It's definitely 2.1 million. It's definitely 2.1. Is it 2.1?
Do what? What do you got, Chris?
It's definitely 2.1 million, but
What?
Chris, it's a negative 100,000.
so it's 7 plus 5.
Hold on, we got
Where
a
are we getting
million.
7?
We got 6. We got
7 plus 5
That's
minus 1.
negative 100,000.
Hold on, is this? There you go. Does that make it better? I'm missing a 0.
Oh, shoot, there we go.
It's okay, buddy.
It took me a while.
Okay, first off, that would be 2.1 million. It would be like.
Well, if it was 100,000,
Back,
really
back on.
You know, we got there in the end, didn't we? Did we? We were missing a 0.
Yeah, but
You-
that,
If it was
that's
100,000.
100,9. That zero is more important than 100,000.
That's true. That's true.
Okay, so how do we convert this tax basis
Reduce AR
to 0?
to
Correct.
0. Correct. Yeah.
Okay, so, and that is a debit or a credit?
That's that'd be a credit.
Credit. Where's my offsetting entry go?
Equity.
Equity. Okay.
100 each partner. I know. It's so many credits.
Okay, and this is bank debt. Is there anywhere else that we would have an opportunity to convert from GAAP to tax?
Accumulated depreciation.
accumulated depreciation. Okay? So the question is my GAAP financial and my tax financial, is my GAAP financial congruent with my tax depreciation schedule? And for ease of what we're doing, I'm going to say it is. But you have to look at it on asset by asset basis to discern where a difference might be. And this might be a good note to take down. Where's a good place to discern where differences might be? And I think we had a conversation about accrued vacation and ISOs and non-qualified stock. What was that section about? What was it?
M1 adjustment.
M1 adjustments. So where do we start with M1s? Book income plus or minus our M1 adjustments to come out to taxable income. Okay, so those M1 adjustments, they're a different accounting method for tax, correct? And that different accounting method for tax, the fact that we take accelerated bonus depreciation versus straight line for depreciation for GAAP, that is a different accounting method for tax. Bonus is a different accounting method for tax, correct? All those M1 items that are represented in that one section are different opportunities to treat something differently for tax. If that's true, then wouldn't the M1 schedule be a great place to look to figure out about what account balances would be adjusted to get it to tax basis? The short answer to that is yes. So there is no M1 for tax depreciation. Book equals tax. Okay? So now we have, step one was to get it to tax basis, right? Is that right?
Yep. Yes.
How much is that, Matt?
1.9? No, 1.7.
Okay, so then what do we do next?
Create fair value.
Okay, we do. But the first thing that again, I'm going to do this a little differently, but you absolutely do that as a procedure. I'm going to say that we're actually going to be buying out C for $1 million the same way we were before. So what is the overall value on my asset and liability side if we're presuming we're buying out C at $1 million? So going back to my accounting equation, my liability plus equity should equal what?
Assets.
Do what?
Assets.
Okay.
Or liability plus equity is assets.
Yes, but right now, I'm inquiring solely on the one side of the balance sheet. I got, what should my fair market value, what is this number? What does that equal? Yeah,
3.5 million?
3.5 million. That happens to be right, but how did you get there?
It would just be the 3 shares times $1 million, 'cause instead of 500,000, they're $1 million now for each of the 3 shareholders, and then the 500,000 bank debt.
Okay, so hold on, you're going too fast for me, Connor. Because what I think you're saying is if you know 1/3 happens to be worth $1 million, the other 2/3 or 1/3 per person is worth $1 million. Is that what you're saying?
Yes.
Does everybody agree with that? Okay, so the accounting equation for the liability, it's asset or liabilities plus equity, right? So Connor got us to the equity section by virtue of inferring what the equity section should be based on the $1 million buyout that we're going to give one partner. Is that what happened?
Yes.
It is. So then the liabilities is 500. So Connor, you said it's 3.5, correct?
Correct.
Okay, so now I know that my asset side of the balance sheet has to be 3.5. Is that correct, Connor?
Correct.
Now, coming back to you, Max, how the hell do I spread that out to everybody? Because at the end of the day, Allie, my definition of proceeds is what?
Cash, property, and debt relief.
Cash, property, and debt relief, which dovetails into my accounting equation of assets equals liabilities plus equity. I know, and Connor inferred, that 1/3 of the interest was being bought for $1 million. Using that as a data point, he then was able to add 500,000 to come to 3.5. So at this point, using his inference, we would be willing to buy all the assets for $3 million of cash and 500,000 of debt assumption. And that $3 million of cash and $500,000 of debt assumption gets me that side of the balance sheet. That's how I say the definition of proceeds and the accounting equation loop in together as long as you can see the picture, as long as you can correlate it. Okay, so now based on Connor's inference, we have $1 million per, gets me $3 million, 500 of equity, gets me 3.5. Now I can say, I now know that my asset side of the balance sheet is 3.5 million of value, correct? So how you fill in the rest?
Cash is the same fair market value.
Okay, I'll give you that. Cash is always cash.
Same with AR, on GAAP basis.
Maybe, maybe not.
Maybe not.
Okay, because there are truly reserves and otherwise. So it's not a bad assumption. And as a matter of fact, it would be an assumption that we make on a very, very common basis. On a very common basis. Well, I don't think we would account very often for an AR. So the client's going to nod their head and say, sure, 300,000, fine. Okay?
Then you got to kind of determine and work with the client manager to see what the fair market values of the building and land are.
Okay? Now, I'm going to kick into what we do at Lutz for the most part. Okay? Now, this isn't right, but it doesn't mean it's wrong. More often than not, you're going to have your manager, partner, or director say, you know what, fair value and book value are the same. Okay, so that would mean that the fair value of the building is 200 and the land is 500. Now, this isn't always true, but this happens quite a bit. Hey, math guy, the one that keeps busting everybody and get gaslighted.
Got 1.5 million to go somewhere.
How do you feel about that, hotel guy?
Seems about right.
Connor?
I'm sure. Yeah.
Okay, so we have $1 million, we have 2 million, $1.5 million. Okay, so there's this concept of goodwill. Okay, goodwill's going to have zero basis. 1.5 million. Okay, there's lots of times when we have an asset purchase or an asset sale. This isn't just confined to a 754. If somebody's going to buy your assets, Chris, for $3 million in debt relief, how much are your proceeds?
3.5 mil.
3.5 million. And let's play with that for a second. Okay? If you have total proceeds, and we did this before, and this is going to come back into this on some level. If we have total proceeds of 3.5 million, which is inclusive of debt, we have basis, we said of 1.7, correct? 1.7 of basis. We have an overall gain of 1.8. Is that correct, math guy? It is? Okay. So we have a total amount. But this here, we sold we sold cash, we sold AR, we sold building, and we sold land, and we sold goodwill, correct? So the proceeds for land is 1 million, AR is 300, building is, we said 200, correct? Land is 500, and goodwill, we're saying it's 1.5. Math guy, do those foot across to 1.5 or 3.5? Okay. Basis is 1 million in cash, 0 in AR, 200 in building, 500 in land, and 0 in goodwill. So my overall gain is 300 and 1.5. Correct? So if this is true, all this is really your balance sheet, is it not? I have 3.5, which is really broken down into 3 million of cash and 500 of debt relief. 3 million, 500 to get to 3.5, correct? And then I have 1 million of cash, 300 of AR, 200 of building, 500 of land, 1.5. So a sailor exchange procedure is very similar to a 734 is similar to a sailor exchange in that you're only taking a piece of what the sailor exchange is. So now that we know our inherent gain is 300, correct? 0, 0, 0, and 1.5. Inherent gain. Was that our next step? We did our tax basis. We did our fair market value. What was our next step? And that's what we just did, is not? So then what's our next step after that?
I didn't really write down that. I was kind of
Isn't it the journal entry?
Yep.
the dangling debit. Is all I have written down.
The dangling debit. I like it. So we got debit, credit. So we know we first go to our probably our GAAP financial, I guess. Which one did I say? Tax basis, right? I did. I said tax basis. Because I'd be an idiot. Tax basis. What is our debits and credits that we pull from the tax basis column?
Cash.
Cash.
And equity. Or
Equity.
yeah, equity.
Cash and equity. How much cash?
Bill.
1 million. Equity?
400,000.
400,000. And these are from our tax basis column, correct? And now where do we pull from?
The inherent gain.
The inherent gain. And what do we pull from the inherent gain column? Do what? What you got, Luke?
Where do you take a third of AR and a third of goodwill?
Why do you choose a third?
Because like all the assets are split equally amongst the partners.
Yes, but that would be 100% true because we're all equal partners, but how much was redeemed?
1 million. Wait.
No. There were 3 people, correct? And we redeemed C. So it's not that they're split equally, it's how much was redeemed. Because if we redeemed more than, like, you redeemed all of C's interest and half of B's interest, then that would be, you'd have to find, that would be 50% at that point. It's proportional to what was redeemed out of the company. So since we redeemed 1/3, my inherent gain column, I have inherent gain in my AR of how much? 300. What's a third of that?
100,000.
So now I have AR of $100,000. I have 1.5 in my goodwill. How much is goodwill?
500.
500. $1 million. 1 million. So what are our steps again? Just to make sure I didn't fall asleep in the middle.
Create a gap balance sheet. Create
convert GAAP balance sheet to tax basis.
Inquired.
Talk to the manager
He's
for
whispering
fair
it.
market value of
Well,
assets.
There we go.
Hold on, CB, give it to me.
First step is a GAAP balance sheet, and then convert GAAP to tax basis. And then third, you'll talk to the manager on the fair market value of the assets.
Okay, where do you always start though? Because we're gonna go back to Connor. Do you remember how Connor, the other Connor, not this Connor, that Connor. Connor said he inferred that the equity section was worth $3 million, correct? This is a pretty important tool to use. I use it all the time. Is I know, let me ask this question. I'm buying Matt's S Corp stock, doesn't matter whether it's S Corp stock, doesn't matter whether it's partnership interest, doesn't matter whether it's C Corp, I don't care. But I'm buying Matt's interest, his 20% interest in the company for his 20% interest in the company for $100,000. What is the overall value of the equity section of the company?
500,000,
$500,000. Why did you say that, Matt?
because 100,000 is 20% of 500,000.
100% is 20,000. So what Connor did earlier was said, well, wait a minute. I know 1/3 of this is going for $1 million, and it just happens that everybody happens to be an equal partner. Okay, it could be that it was A, B, C, D, and C was 1/3, and there was some other variation in the others. But Connor used the 1/3 interest that was there to say 1 million is going out for 1/3. Therefore, the overall equity section is worth $3 million. It's worth $3 million. Million. And then you take that million and divide it into, or divide it among the proportionate ownership interest in there. I just happen to be a third, and a third. Okay? So your starting point, Connor, you said get the GAAP value, correct?
Yes,
Then you said tax basis, correct?
yes.
And then you said go to the manager and figure that out. We're going to insert some steps in between that to say, well, let's figure out based on the transaction that's occurring, what's the fair value of the equity section? And that is going to be using the sold interest as a proxy, the same way we did with Matt, to say, I bought his interest, his 20% interest for $100,000, which inferred a value of 500, because 20% of 500 happens to be 100, and you can reverse engineer back into it, correct? Then you add liabilities to that. Then you get to liabilities plus equity. Now you know the sum of those two numbers happens to be worth $3.5 million, do you not? I mean, that's the simple accounting equation. Now you go talk to the manager.
And then next step is do the inherent gain. And then you'll do the dangling debit.
The dangling, did you come up with the dangling debit?
No, you did.
No.
And then you pull that from tax basis.
You pull what from the tax basis?
The gains.
Nope, you pull you take the things off the balance sheet that no longer exist.
Yes.
That's coming from the tax basis column. So in this case, the things that no longer exist is cash, and C left the building. So what's coming from the tax basis column is what left the building, which is the cash and C's equity. Okay? So the dangling debit, though, or credit, as the case may be, is coming from the inherent gain column, is where that's coming from. Which the inherent gain column has two assets, or two line items or assets, which is AR and goodwill. So your dangling debit, as now we're calling it, is going to be the amount of inherent gain in proportion to the amount redeemed. So 30% or 33% was redeemed. 33% times 300,000 is 100,000. 33% times 1.5 million is 500,000. Are we here to be experts?
Build a foundation.
Build a foundation. Okay? If Mackenzie walks in and drops the 754 on your desk, do you have an expectation that you're going to be able to execute this at this point? Probably not. But do you think you have an opportunity to fumble about and screw it up? You do. And that fumbling about and screwing it up, do you think you have the opportunity to go, okay, this is what we had from class. And I can take this Post-it, this half-assed Post-it that I'm not going to remember at all what the hell it says. And I'm going to take that and maybe go back and watch whatever this video that we put together, because this is going to be published at some point internally, to say, how did that work? And the more you fumble about and don't say, Mackenzie, I give up. I'm waving the white flag. Here's this piece of crap, piece of work that I did because I gave up. Make the mistakes. Because the more mistakes that you make and learn from that mistake, the stronger you get. The more you go from being a staff person who can barely find where the bathroom is, closer to a consultant. Because we're at some point, your foundation is going to turn into
Being an expert.
being an expert. I mean, you got to pick up these pieces, and you have to take them and put them together and see. We've talked about proceeds. We've looped proceeds in through this deal. We used estate and gift based on talking about 754s, and the fact the estate and gift now affects 754 if you have an inherited interest. And you look for the big picture of how this stuff correlates. By the way, this makes me happy inside. No.
I almost
No.
said it.
I know what you almost said.
I gave up after the first time.
This was the easy one. Okay? 734, by virtue of us being accountants, is the easier one to understand. And 734 is for what transaction?
Partnership.
Redemption.
Okay, so let me ask a question before I move on to confuse you even further. Do you have any questions, comments, anything that is really hard to understand, or something that I can clear up in what I've said? Because I'm generally okay at looking at you going, where are you at? Are you getting it? And the reason I went over this not once, not twice, but a third time is the first time you guys kind of looked like I was talking about foreign. Okay? And then the second time I'm like, oh, okay, we've cracked through a little bit. And then the third time, I think we cracked through a little bit more. At least that you could articulate that there's some semblance of a procedure and a thought process to go through and get this done. So the question I have is there anything that's really confusing that you're left behind? You know, I don't believe any of you right now, right? Yeah.
So I have a question. So you're just putting it to land and goodwill, but you know how I was saying, like, sometimes the manager will be like, oh, put it between 7-year furniture, 15-year land improvements. Is that for, I mean, I've done that, but obviously I didn't.
754?
Is that 743 instead of 734?
Nope, it's all going to come down to, because you still have the same process of coming up with an inherent gain balance sheet.
Okay.
And that inherent gain balance sheet is where you're going to push the step up to go to.
Okay. So they just want to spread it out over
So,
different
okay,
years, or what's?
Yeah, so let's talk about, because how stupid am I? Why are we even doing this? Because the question Matt just asked was, well, a manager told me that I want some of this to be in 7-year and I want it to be in 5-year, and you're doing it all to goodwill and you're doing it to building or land, or what are you doing? So the point of the step up and this probably would pop out a little bit more with respect to 743 when we do it, is how much the goodwill was, in my example, was 500,000, and we had land, or AR. AR was the other piece. Okay, and we talked about, I can't remember where we talked about, so I'm gonna let that go. Okay, so we now have a step up in the AR of how much, Max?
Step up was like right here.
Yeah.
300,000 or like 100,000.
It was 100,000. Okay, and going back to, I bought your company that had $100,000 of AR. I get an acquisition cost of 100, and when I collect the money from Jackson, there's no gain or loss to me because I have an acquisition cost of 100, right? So in doing this, now when we collect that $300,000 of AR, we're only going to report $200,000 of income because we bought 100 of it by virtue of redeeming out C at $1 million. So the other piece though was this goodwill, which was 500,000. Anybody know how long goodwill's amortized over?
15.
15 years. Okay? So now by virtue of buying out C and doing this step up and going through this process, we now have a $500,000 goodwill item on the balance sheet of the partnership. So over the next 15 years, we're going to get a $333,000, no, excuse me, a $33,000 deduction every year. 500,000 divided by 15 is 33,000, is it not?
Mhm.
So now every year, we're going to have a $33,000 deduction that we have to offset against our ordinary income. Absent doing a 754, when we collected the AR, we would have had $300,000 in income, not 200,000. And when we earn income over the next 15 years, we're able to reduce it by $33,000 a year, which is the $500,000 goodwill number divided by 15. That's the reason that we're doing the 754. To capture those step ups, to shield us from the gain that is embedded in that balance sheet, and to get the deduction. So your question, now that I've answered the question before the question, is, well, why wouldn't I just shove that amount, if possible, to 7-year assets and 5-year assets, which I can take quicker? Okay? Well, if we can, we would. But there's a tension in between buyer and seller. If, there's, okay, I'm going to go ahead and do the concept. When you sell or exchange a partnership interest, it's the same as selling GE stock, Tesla stock, or any sort of stock. Code section 741 says when you sell a partnership interest, it's a capital gain transaction for tax purposes. But for GE and Tesla, there's no except. For partnership interest, there's an except. So when you sell a partnership interest, there's a concept called hot assets. And a hot asset is an asset which, if the partnership itself sold all of its assets, so if the partnership sold, cash, AR, building, so on and so forth, if it generated an ordinary income, you have to recharacterize a portion of your gain as ordinary out of the capital gain that you just generated. So if we look at the example we just did, I'm going to say that we convert this to cash basis, which means everybody's equity, tax equity, is at 400 grand, correct?
Mm-hmm.
Everybody remember that was 400 grand? But stupid question. What is the basis that we had in our AR?
0.
Zero. If we collect AR, is that a capital asset or is that an ordinary income asset?
Ordinary income.
Okay, so let's focus in on the sale or exchange that I just said what would happen. Proceeds, Ally, is what?
Cash, property, and debt relief.
So and I'm going to just focus solely on cash because I'm going to be lazy. Is that okay? Okay, so I got cash, I said of $1 million, correct? Is that what was coming out of the partnership? Basis, when we converted to tax basis, was how much? 400? 400. 600 to gain. So 741 says that should be a capital gain. But I said there's an exception. To the extent that the partnership balance sheet has hot assets embedded in that balance sheet, you got to recharacterize a portion of this as ordinary. So how much did C own of the partnership?
A third.
Third.
A third. How much basis does the partnership have in the AR? 0. How much AR does it have? 300. What's 1/3 of 300?
100.
100. So 751 says $100,000 has to be recharacterized as ordinary. And now you have a $500,000 capital gain. Now I can't remember the K1s that come with like Northern Pipelines or whatever. They have all the hot assets. I mean, is that right?
I don't know.
There's like a bunch of K1s that come in and say, you need to recharacterize a portion of your gain
Yeah.
as ordinary.
Yeah.
But they're pipelines, right? I think. Okay.
I don't know.
Neither her or I know, but I think they're pipelines. There's a subset of K1s that we get all the time that said, hey, you sold your K1 interest, and oh, by the way, whatever gain you come out with, they'll give you the number. They're going to say you need to recharacterize $100,000 of that gain as ordinary. And it's in some sort of schedule or footnote or something on those K1s. So that's what that's talking about. How did I get here? Oh, back to your question. So you said, well, why wouldn't we put things in 7 and 5? Well, the cash basis AR, there's nothing you can do about that. It is what it is. But when it comes to 5 and 7 year property, if you have, let me ask this question. If you have a 5-year property that you bought for $100,000 and you took bonus depreciation on it of $100,000, what's your tax net book value?
You said the base or the cost was 100,000. It's 0.
0. Okay. If you sell that property for $50,000,
You have a gain of 50.
you have a gain of 50, and what's the character?
It's ordinary
Ordinary. Why?
because it's fully depreciated and it's 1245.
1245. Everybody remember 1245. So now we're back to that particular section in the book that we were on 1245, which now is useful for the purposes of this portion of the discussion. If that asset, that $100,000 asset that had the basis of 100,000, and let's just pretend this is ordinary when we're done. To the extent that there's a gain in that at the partnership level, the 1245 asset, which 7 and 5 year assets are 1245 assets,
Yep.
that's going to result in that same 751 recharacterization. So me as the seller, that PP&E is worthless because I don't want that gain recharacterization. Buyer, on the other hand, says, wait a minute, I want the depreciation, and we bought it just yesterday. So how can you say it's worth 0? Okay, so there's an adversarial interest in buyer and seller in that instance, and the seller says, I don't care we bought it yesterday, it's useless. But I want the depreciation. I'm paying for it. Okay, so the 5 and 7 on 754s clearly are available. Okay, so I'm going to keep this gap equals tax. Okay, so that piece of our work, do you have something, Connor?
No.
Okay, that piece of our work is completely done. We don't have to worry about asking the client. We don't have to worry about looking at the M1 schedule. We don't have to worry about any of that. Okay, but C is entering into a contract with Sam. Sam wants to buy C's interest for $2 million. Is that partner to partnership or is that partner to partner?
Partner.
Okay, so we're going to use the Connor M rule. What is the fair value of my equity section in total? if C owns 1/3.
6 million? Do you
How
say
do you feel about that, Sam?
Right.
Okay, 6 million. Right? And I'm going to do this the right way. So I know that my equity section is worth 6 million.
6.5, I guess.
Well, I'm dealing solely with equity for now.
Okay.
Okay, because okay, so how much does A own of the partnership? A third. What's a third of 6 million? Okay, how much does B own? Okay, and C owns. So it just so happens that it's 2 million, 2 million, 2 million, solely by virtue of A, B, and C owning the exact same amounts. Everybody okay with me just drawing that down? Okay. So, Allie, what's my accounting equation?
Accounting and proceed.
Accounting equation. Assets equal.
Assets equal liabilities plus equity.
Okay, so I have my equity, right? What's my liabilities?
The 5.
500. So now I have 6.5 million of total, right? So now I come back up here to the asset side, correct? For 6.5 million. And I'm going to say, for ease of what we're doing, every tax or gap and tax net book value equal fair market value. Because that's what we would do, except when somebody's dealing with Matt and they want to yank his chain and make him put 7-year property. Okay? So what's the fair value of cash?
Million.
$1 million. What's fair value AR?
300,000.
300. The building? 200,000. Land? 500. Math guy?
What we got there? 2 million. We need plug figure of 4.5 million.
Plug figure of 4.5. I agree. And that is associated with what?
Goodwill.
Goodwill. Okay. Well, all right, this feels startlingly the same so far, doesn't it? Okay, and one of the reasons I did debits and credits and entries first is to show you kind of this procedure, and you shouldn't be afraid of this procedure. So A or C sold its interest, his or her interest, correct?
Correct.
Does anything move on this balance sheet? Because when we had a redemption, the company took its $1 million on its balance sheet, used that $1 million and bought C's interest, and we had an entry that we had to confront, correct? We had to credit cash for $1 million, debit equity for $100,000, which came from our tax basis column, and then we had the plug, which came from our inherent gain column, correct? Well, what the hell do we do now? C sold his interest to Sam for $2 million. No cash came on the balance sheet. No cash exited the balance sheet. Nothing came on the balance sheet or exited the balance sheet. This is 743. 734, this is why 754 says, do we want to be open to a basis adjustment, yes or no? Yeah. And that's why we have 734 that says when you have an adjustment due to partnership redemption, you have entries. That's the procedure. In this case, there is no entry. There's no entry to be made. So, what's the next piece on the gap piece? We've got our fair value. We need what's the next column we need?
Inherent gain.
Inherent gain. What's the inherent gain in my cash?
Zeros.
AR?
All zeros.
All 0 except this. Okay? Is that right? So now that you got there, how much of the partnership was sold?
A third.
How much?
A third.
A third. So now it's like, take this times 1/3. Is that $1 million? one, what is it?
1.5.
1.5.
One, oh, fuck me. Okay. I'm going to say that my cold is getting the better of me. Okay, 1.5. So, Sam's step up is 1.5. Okay, so why don't we prove this out to see if this is true? Okay, and we're going to use, I'm going to erase this. Is that okay? This over, is that all right? Because we know it's 1.5. Okay. What's 1/3 of, well, let's just loop these together. Okay, because what's 1/3 of 2 million? 667. Is that the right number?
Chris is the guy for that number.
Is that really the right number?
I think it's
Rounded
it's
up.
all sixes. Yeah, it's good round.
No, it's all sixes. Is that what you're saying?
Yep.
And 1.7 of that.
1.7. Let's go with that. Okay. And
6.7.
these are tax basis assets. Okay. And the equity section, or the liability section, 1/3 of 500 is what? Somebody just do the calculator. Come on, you can do it.
Can't do that in my head. Connor's got it. Yeah, there we
What?
go.
166,667.
166.67. Okay, this is my debt. Correct? What's C's equity?
500.
Do those numbers come out the same? Okay. Sam is willing to buy this interest for $2 million. Is that what we said?
Mhm.
So we're going to use the same procedure. Equity section is $2 million, correct? We add liabilities to it, don't we? For 2,166,67, correct? Is that right? So now we can populate 2,166,667, correct? We know tax basis and GAAP or fair value are the same, correct? 666,667. What's my plug?
2.
Goodwill.
And how much?
1.5.
1.5. So I took 1/3 of the gap and put it over here. I took the purchase price and 1/3 of the debt to get to the total. Total populates, and I do the same thing. It proves out. So by virtue of starting with your GAAP financial, your fair value, inherent gain spitting out, at that point, you had 4.5 million, did you not? What percentage of the entity sold? A third. A third of 4.5 million, shamefully, that I didn't know, is 1.5 million. And these entries help, or this procedure, this proof, kind of shows you how you get there. So let's compare and contrast for a second. On the 734, we had $500,000 of amortization, did we not? And it was $33,000 of amortization, correct? That $33,000 amortization is going to affect A and B, the remaining shareholders. A and B basically said, you know what? Disproportionately take $1 million, go away. So C took a disproportionate amount of A and B's cash and left stuff behind. So it's as if you could think about A and B bought C's stuff. And A and B is the remaining partners, since we use partnership assets to take out C, get to share in the step up. Who bought out C here?
Outside person.
Outside person, also known as Sam.
Sorry, Sam.
Okay?
That's okay.
So Sam has a step up of 1.5 million. So that step up of 1.5 million, so let's do it this way, just so we're clear. What the hell did I do with it? So, does everybody have this that wants it? So now we have this step up. I'm going to call this step up column. We're going to keep this. Everybody's got the procedure to get there, I presume. Okay? Nothing was affected on the balance sheet of the partnership under the 743, correct? And I'm going to say, and it's a third, and a third. So the partnership taxable income is 300,000. A, B, and Sam. And Sam was my purchaser, correct? So we're the third, and the third, are we not? Okay. So how much income should go to Sam, or A, B, and Sam?
100.
100. So, but Sam has a step up under 743. So now this is a term of art. Under 734, A and B were deemed to have purchased the assets by virtue of using the partnership assets, correct? That's called an on the balance sheet step up. It's on the balance sheet because you use balance sheet assets to harvest or take out C. Sam's purchase is an off the balance sheet transaction. There's nothing that affected that balance sheet. So we now have an off the balance sheet step up. $1.5 divided by 15 years is how much? 100,000.
100,000.
Now, I honestly don't know. Mackenzie, do you know what code this is for 743 on K1?
13V,
V is in Victor?
maybe.
Okay. Okay, so Sam's K1 is going to have line one income of $100,000. But he's also going to have this 13V is in Victor, correct? 100,000. And when he reports this on his 1040, he was reporting 0 by virtue of getting the benefit of his off-balance sheet step-up.
They recently changed it.
To what?
Well, it might be in box 20 now.
No.
I think they've changed it twice in the last like 4 years. Because they changed it when, only 730. Because sometimes we had 743 on the balance sheet when we shouldn't have,
Yes, we're not covering that
Yeah,
today.
yeah. So when that happened, and then I think it happened again, it might now be in box 20U, but don't quote me on that.
What Mackenzie was talking about is there's a Lutz way.
Yeah.
And then there's the right way.
Yeah.
And the Lutz way would have captured that, would have taken that 1.45 million and put it on the balance sheet of the entity. And the reason that we put it on the balance sheet is, let's say that the step up was, we've had land, we've had goodwill, we've had AR, we've had building, we've had multiple things with a step up, right? So if it goes to land may not be sold for 20 years, right? I'm not going to be here in 20 years. How old are you, Mackenzie?
How old am I? 26.
She'll be here in 20 years. You got a shot. Okay, she might remember the 754 step up, but I give it something less than 100%. Okay, so what we do, and it's not cheating the system, it's not cheating the IRS, it's not cheating anybody. We will take that land when it's off balance sheet, and we would say, we would put it on the balance sheet that says 754 step up, Sam. And we know that Sam has a higher basis in that particular piece of property. So when we sell it 20 years from now, when I'm gone, and McKinsey has potentially forgotten, that line item on the balance sheet, 754 Sam, lives in perpetuity. Hopefully we're smart enough to harvest it and not shove 100% of the gain to Sam. He's going to get a write-off because we were smart enough to put it on the balance sheet and cheat the system. That's what McKinsey was talking about.
But what we do now is you just track it in the fixed asset software. So we normally have a separate group called 743B assets, and they're all listed there so that they roll forward every year so that we don't forget.
Any questions? 754 is a lot. There's a lot of moving pieces in there, okay?